Okay, our discussion was on, our discussion was on, almost to the end, because we're near the end now. Okay, so this is where we were. We were talking about synthetics, okay, and we were talking about, we have already discussed, so we're talking about individual positions. So we have 6 positions, and we are discussing their synthetic equivalents. So we have already discussed the long underlying, and everything is at K. Okay, everything is at K. And here we were discussing the long underlying and the synthetic equivalent. So we've discussed up to here, we've discussed up to short put. Okay, and so we'll continue from there. The short put, now, since we discussed for the short put, now what we start with today, we start with this there are 2 important strategies that you should hear about. That is covered call writing, and in between, we are sort of interrupting our sequential discussion of, these are 2 very common strategies, so we should discuss them here before we move on to, or we can put this discussion here, actually, at the end. We'll keep our synthetic equivalents together, and we will just go through here's the reference here. So I have referred also to the, let's put this, I'm trying to put where we have a topic kind of coverage. I'm trying to put it in the center, and cash, if you want to put writing, we'll keep it in another topic. And all right, so let's understand. So this is where we are. Why are we discussing covered call writing? Because we were discussing the positions and their synthetic equivalents, and one of the positions we discussed was the short put. Let's look at the, let's bring this here. We are talking about the reference to Hal Basu is in book 254, which would mean, and if I'm giving the page numbers like this, so it's in book is 254, that's what is printed in the book, on the page of the book, and this is the metadata page number. Okay, so to get here, what I do is I get to, what is the page number I need? 254. I will type 253 in this, in the metadata, and I will get to 254. Make it 115 maybe. I think that should be fine. This is where we were starting at. Maybe we can make it 120. Yeah, so 12.2 is where we were starting. So this is the reference for, so this is a long put, and this underlying is a short put. Okay. Now look at this here. What are we talking about here? So we were talking about this one, right? Short put, long underlying plus short call. Okay. And so short put, let's look at the short put position. And this is what brings us to the discussion of This is what brings us to the discussion of the covered call writing strategy. Okay, so we will just briefly discuss it here, and then we will come back to the rest of the synthetic equivalents. So let's look at the short put profile. And this is why I gave you the CME reference. You will notice CME if you go to page 9 or something. I think it's page 9, maybe 6. Yeah. So we were not able to show you. I didn't have the CME open the other day. You can see CME also long futures. Okay, long futures. You will see the equivalent also given here. You'll see some of the. This is one of the biggest exchange groups in the world, CME group. And you can see here the long futures position, when they're talking about the long futures. They've discussed, you should go through this book. There are many option strategies mentioned here. We can't cover everything, but this you can use this to increase your learning on the, on your own. Here you see the use of the word synthetics. Okay, you can understand why I'm using that word. So synthetics, by synthetic they mean synthetic equivalent. I hope everybody can see the word synthetic here. Synthetic here means synthetic equivalent. So you can see long call, short put. And A is the strike, and A is the price at which you're long futures. Okay, so this is actually a bit too big. Maybe we should make it 150, and you can see everything. You make it 150 is fine. Right. So here you can see this is the A and A your long futures, and you see the synthetics is long call A, short put A. So you can see long call plus short put. You will see the equivalent also in our notes, which is long underlying is long call plus short put. Okay, so this is what is meant by the synthetic equivalent in this booklet. So that's why I've given you this booklet as a reference as well. So let's go back now to the hull page and let's look at the short put. The short put is given to you as, this is the, remember the scheme of these diagrams, is that the dotted line is the underlying position. Well, not necessarily the position in maybe we shouldn't use the word underlying position. The dotted line is the position, which is the terminology I've used in your book, in your notes. I haven't called it underlying because we are using the word underlying to refer to only the long underlying and the short underlying. So puts and calls we don't refer to as underlying. So that's why I'm not calling this underlying position. I'm calling it a position. And then we are discussing the synthetic equivalent. So if we look at the short put, so the scheme of this diagram is that the solid line is the position, and the two dotted lines are the solid line is the profit profile for the position, and the two dotted lines are the profit profiles for the two positions that constitute the synthetic equivalent of this position, that is represented by whose profit profile is represented by the dotted by the solid line. So this is obviously, if you remember, this is a short put. How do you identify it? First of all, you look at where any option position, any profit profile for an option position, you first notice where is the constant part. Is it below, like here, the constant part is below the zero line. And here the constant part is below the zero line. So what that means straight away is that this must be the part, the constant part in an option profit profile. Now we're going back to the fundamentals of how to, refreshing the fundamentals of how to analyze and understand option profit profiles. That we have, the first thing we look at is the constant part. So the constant part is the part where the option is not exercised. Okay, that is true for all whether the constant part is below the zero line or above the zero line. Okay, so maybe we should write this down for your benefit. Okay, maybe we should write this down for your benefit here, just underneath this chapter, this particular segment. We should write it down so that you know exactly analyzing option profit profiles. You notice that I'm using the word profit profiles, not payoff profiles, because in the case of a payoff profile, you will see there are some diagrams here. I think there's further down in this chapter, there are some diagrams of payoffs. You may find them if we go further down. Okay, never mind. We'll do that later. But clearly what will happen in the case of a payoff is that in the case of payoff profiles, the part that is above the zero line and below the zero line, that will not happen. Because in the case of payoffs, we are looking at, we don't include the cost of the option. So this part will collapse to the top. This part will collapse to the down, to the downside. So in the case of payoff profiles, this part that is constant part above the zero line or below the zero line is not going to exist. That's why I'm using the word analyzing option profit profiles. Okay. Logic. So what do we do first? Let me give the correct definition, which a computer will understand. You notice the part of the profile that is parallel to the x-axis. So I'm talking about this part or this part. Okay. So let's put it this way. If that segment is above the zero line, then this is the profit profile Okay, here, fill in the blanks. Who wants to fill in the blanks? So I'm saying notice the part of the profile, well, I'm not putting perfect English here, actually the part of the profile, the part of the profile that is parallel to the x-axis. Okay, Utsav, this is what should be the fill in the blanks here? Short position. Okay, let's see if Utsav is right. Okay, so short position, not long position. Okay. If that segment is above the zero line, what did we just say? Notice the part, I'm looking at an option profit profile here, one here. Okay, the part that is above the zero, the part that is parallel to the x-axis, so I have fixed my eyes on that, this part. And I am saying that if that segment is above the zero line, then this is the profit profile of a short position according to itself. Yes, he's correct, because the profit profile, the part that is parallel to the x-axis, represents all scenarios where the option is not exercised. And if the scenarios where the option is not exercised, and this is for the these profiles are for the holder of the option position, whether the position is short or long. Okay, so let's write that also. Okay, I'm just making everything go in baby steps. I hope some of you may find this a little boring, but I want to make sure that everybody understands the fundamental logic. I don't want anyone to memorize stuff. You have to understand everything through baby steps logic, and in the way that a computer will understand it. So That's why I'm writing it like this. I'm discussing it like this so that your foundations are 100% clear. Okay, these profit profiles, this is kind of obvious, but I'm still writing it. Sometimes holder, you might think that this means long. No. Well, I hold a short position. That's how we talk about it. Okay, position is long short. Okay, these profit profiles for the holder of the position where the position is long short. Let me write this also. Notice part of profile that is parallel to the x-axis. This segment part represents all or represents P&L for all scenarios when option is not exercised, or we also say option is a common term that we use in the options market, that the option expires worthless. Okay? So it is not exercised. Now, this represents, so as Utsav has correctly pointed out, so this segment, so how do we, what is the logic? Why is Utsav correct? Because two steps, this part represents the outcome, the P&L outcome for all scenarios where the option is not exercised. So if the option is not exercised and then you make a profit, we are saying that this, if the segment is above the zero line, the option is not exercised and you're shown as making a profit. Whenever the option is not exercised, you're making a certain constant profit. That means you must have sold the option, because it is the seller of the option who pockets a constant premium when the option is not exercised. Okay, so if I buy medical insurance, the insurance company is the seller of the option, and if I buy medical insurance and nothing happens to me for the year, that means the premium I paid for that year, all that, I don't make a claim, so the option is not exercised, so the insurance company is going to just keep the money that I pay. I can't ask for the money back. The premium that I paid, it's gone. Okay, it's in their pocket, so they will retain this money. So that's why this is the correct answer. Okay, so think about this. And so, and of course, then we can flip the line around and say, this should be long. So the part that is important here is below and above. Right? So now we know this. Okay, so straight away, so what we are doing is we are learning some fundamentals of analyzing option profit profiles logic. Let's put that as a topic. Logic. Okay, so notice first part is notice part of the profile. Now you've understood straight away. When you look at this, you know it's a short options profile. You look at this, you know it's a long options profile. Again, here, this is this long or short? This solid,
Long,
yes,
long profile.
long option, right? And this one is
Short.
short. Whatever it is, call, put, whatever, this must be a short option profile because the constant part is above the zero line. Okay, and then we'll later on figure out whether it's call or put. Okay, now we look at the logic for analyzing the second part, which is now look at the notice part of profile that is parallel to the x-axis, and the other part of the segment, the other segment of the profit profile, we will refer to as the part that is cutting the x-axis. Okay, notice the part that is cutting, we call this if you some geometry terms, intersecting the x-axis. Okay, the part of the profile that is intersecting the x-axis. Now, how can we characterize this part? What are the two ways? We notice, let's look at the patterns. Here it's intersecting the x-axis. Here it's intersecting the x-axis. And here also it is intersecting the x-axis. So let's maybe make this a little bit 95, and we can see everything in one view. 85. And how should we characterize this? So we are looking at one simple way to characterize. It's like we are teaching a computer how to analyze option profit profiles. And the computer doesn't know anything, so you have to tell him everything. So because this is not doesn't mean that I think you're stupid. It's just that I want to make you think like a computer, because then you go completely based on logic. That's what that's the objective of this. Okay, so we want to characterize this line, this line, this line, and this line, this part, this segment, these four segments in a way that is in one general way, which will capture all the four varieties. Okay, so what should we say? It's intersecting the x-axis. So we will say if the P&L is increasing as the underlying price increases, like here, if the P&L is increasing, okay, we will P&L increasing means profit is increasing, okay? Because if P&L is decreasing, if you make a loss, minus $400 million, so that is, compared to say last year you made a profit of $100 billion. So we say the P&L has decreased, okay? So decrease in P&L, it includes the idea of making more and more losses, and increasing the P&L or less profits, and increasing the P&L includes the idea of increase more and more profits and less and less losses. Okay, so we will say that if the P&L is increasing when the underlying asset price is increasing, that is for all scenarios. Remember, these are expiration date scenario analysis diagrams. So expiration date, we imagine, okay, what happens if the stock finishes, the underlying asset price finishes here? What happens if it finishes here? What happens if it finishes here? For all these scenarios, what is my P&L? Plot it, then join the dots, okay? So we say if the P&L is increasing as the asset price increases, then it must be a what position? if the PNL, there is, how many situations do you have here? Let's look at it. If the PNL is increasing, here the PNL is increasing as the asset price increases. And here the PNL is decreasing as the asset price increases. Okay? Now here, if you see, here the PNL is increasing as the asset price decreases, and here the PNL is decreasing as the asset price increases. So we have 4 scenarios, okay? So let's write down those 4 scenarios, okay? Okay, actually this goes into a kind of a matrix, okay? Let's see if we can do it as a matrix. Let's open your... Let's try to do it as a matrix. And later on I'll put it into a separate... What do you have? Look at this as... Yeah. And here we'll put asset price. I'm going to increase this one. So we'll make this asset price. Yeah, line price. Okay. Let's do this as a decrease. Okay. So we are talking about, can you guys still see this? You can actually just make it easier for you to write using this like this. Okay, so we look at 2 scenarios where we have 2 dimensions, PNL and underlying price. We see situations where the PNL decreases, the PNL increases, the PNL increases, and the PNL decreases. Okay, and we also see underlying price increasing or underlying price decreasing. So we can put them into a matrix and look at it like this. So first case we consider is PNL is increasing when we'll put this here. PNL is increasing when the underlying price is increasing. This is this one. Okay. We already have a formula for figuring out this part. We already have a formula for figuring this part out. Okay. That we know how to figure out whether it's a short option position or a long option position, because we are going to look at the segment that is above or the segment that is parallel to the x-axis, and we will figure out whether it's a long option or a short option. Okay? So we are already looking at completed profiles. So we will already have and now we are going to consider in part 2 of the analysis, we are going to consider the part that is intersecting the x-axis. So we will look at, when we are looking at the part that's intersecting the x-axis, then we already have information because we are looking at a completed profit profile. We would already have information about whether the parallel part is below the zero line or above the zero line. Okay, so now we look at a situation where P&L is increasing where the underlying price is increasing. Let's look at which scenario is happening. How many scenarios do we have in these 4 charts where the P&L is increasing? Let's see here. We have there's no full screen happening with, should happen with F11, but anyway. Maybe Adobe has its own shortcuts. So yeah, now you can see 4. How many scenarios do we have here where the P&L is increasing when the underlying asset price is increasing? Yes, anybody? What happened? Everybody's sleeping. Who should we ask? Let's ask Sresht. Sresht, how many scenarios do we have here where the P&L is increasing while the underlying asset price is increasing? P&L increase, underlying asset price is increase. Okay, so AA has raised his hand. Yes.
Sir, long call.
Sorry?
Sir, C part. C, the graph shown in C figure.
What you're saying is, yeah, there's only one, the C part. So this according to you is what kind of
The long call.
sorry?
The long call.
Long call, correct. So it is basically, it's only going to be a call option where the profit profile will keep on increasing as the underlying asset price increases. Only a call will have that position, and this must be a long call. Okay, and the long call will have that position, and you can also confirm it that it's a long position by looking at this. Okay, so we'll now quickly wrap up this part, and we will give you the matrix position. Okay, so this must be a long call. So I think many of you are making this mistake that because I'm not, it's not as interactive as maybe some of the other case-based courses. But if I do that, I would lose a lot of time. So for your own benefit, I'm actually having it more like a lecture tutorial structure. But I think most people are just saying, okay, this is becoming boring. But it's not, you don't even have a right to say it's boring because you have signed up to be a finance student. So this is stuff that you have to understand. And you can only complain if the teacher is not explaining it properly. So you have to find this material interesting. It is your duty to learn this material. The reason I'm doing it through this kind of a lecture tutorial method rather than doing a case study method where I keep on asking 20 people, what do you think? What do you think? I write the answers on the board. that'll take me a long time to go through some of the concepts. So you have to make sure that you understand thoroughly all the logic over here. Okay. So as our AA has correctly classified, correctly answered, the answer here is a long call. Okay. So I'll just go into mute for. Okay, second situation we will look at. Let's go by the matrix. PNL decrease while asset price increase. Okay, which kind of option PNL decreases as the asset price increases? This will be a short call. You can figure this out later. This will be a short call. We can check it. How many scenarios? Only one scenario, because each of these will be only one scenario. Here's the scenario where asset price is increasing, PNL is decreasing. Right? Asset price increasing, PNL decreasing. This is already a short position we know from here. And it must be a short call which will have this profile where asset price increases, PNL decreases. So this must be a short call because as the asset price increases, the intrinsic value of the call goes up. Okay, so this actually is, you have to think of mirror images. Okay, so it's like here, you take this and you hold this and you flip it around. Long call, short call. So long call, you take this and you flip it around, and this is kind of maybe not exactly a mirror image in physics terms, but it's loosely we refer to it as a mirror image. Okay, so this is the opposite side of this position. So here, so this you can see is the opposite of this, and this is the opposite of this. Okay, so here asset price going up, option PNL going down, option position PNL going down, so position must be short call. Because intrinsic value, once again remember, nothing is to be memorized. Everything has to be explained logically. The reason why option, as the asset price goes up, the option price, you remember this logic. As the option price goes up, as the asset price goes up, option PNL is decreasing. Why? Because as the asset price goes up, strike price is constant, so the intrinsic value of the call option goes up, as whether you're long or short, it's going up in the same way. So the intrinsic value of the call option keeps going up, and that means the total value of the call option keeps going up, and you are short the option, so therefore you will keep on losing money. Your PNL keeps going down. Okay, you're making bigger and bigger losses. So that's why this is short call. Similarly, next one is PNL increase. Underlying price decrease, PNL increase. Where do we have that? Underlying price decrease, PNL increase. So this you can see is, what is this position?
Long put.
Long put. See, long put, because that is the only position that will behave like this. Actually, the put profile. As once again, same logic. Practice all this logic in your head so that your fundamentals are very clear. Later on, you can do advanced study in options, but your fundamentals should be clear. Why is the option value going up as the underlying drops? Because you can, strike is constant. If you can even reverse the logic, you can say, if the option value is going up, that means that either the time value is going up or the IV is going up, intrinsic value. But these are expiration date diagrams. So therefore, there cannot be any time value. So therefore, whatever happens to the option value must be happening because of intrinsic value. If the option value is going up, that means the intrinsic value is going up. If the strike price is constant and the intrinsic value is going up, okay, as the asset price drops, okay, then it must be true that this is a put option, because if the asset price drops, the call option value will keep on getting more and more worthless. So therefore, it must be the put option which is increasing in value, and therefore this is a put option. So this is how you should think about it logically. So therefore, the put option is a long put, and it's a long because this is underneath. So this is long put. And similarly, there's only one left. So PNL decrease, asset price decrease. Okay. So this must be PNL decrease, asset price decrease, underlying price decrease, PNL decrease. So again, same thing. This is happening where you're holding a long, you're already holding a short position because this is here, and here your PNL is decreasing as the underlying rate. Same reason, because it's the put is becoming more and more valuable as the underlying price drops and the strike price is constant. IV keeps going up, so you're losing money. So here is short put. So we can put this discussion here. Okay, so you can see this box here. Now, okay, so let's go back to this. So this is a framework for you to understand. So make sure you understand all these things very clearly. Okay. So let's quickly go through the rest of the. Now I think it should be quite easy to figure out, given this logic at into the scenarios here. Okay. C. A43. If B43 to G51. And I'll link to this also. You can directly click on this. Okay. So now you have the analyzing option profile logic. Okay, let's go back to where we were. Now, we are going to look at the covered call writing first. Before we go back to that, we'll look at covered call writing. So this this thing that you studied, equivalent of short put is long underlying plus short call. Okay. Short put position, synthetic equivalent, long stock. Okay, so he has written stock actually because he's given the example of a stock. But actually in general terms, it should have been written as long underlying. Okay? Long underlying, short call. So we will read it as long underlying, short call. So you can see here, it's a long underlying short call. Now this particular strategy has another name. So if somebody asks you in an interview, what is covered call writing, then you can answer it in many ways. When people have long stock, very often what they do is they write a short dated call to pick up some premium income. Notice that if I go short a call, I am gaining some premium income, and if I'm lucky and the option is not exercised, then I will pocket this premium. Okay, so typically what people do, I'll explain the logic here. Now this is a covered call writing. This is not how I should write it. I should write it this way and then like this. Because short put is not covered call writing. Okay. This part is called covered call writing. Okay. Why is it covered? Covered because what we mean by that is this, that if the short call is exercised against me and I start showing constant losses, I'm not concerned about that. That is not a net loss for me, because as the underlying moves above K, then my underlying is also making a profit. So as the asset price keeps rising, I'm also long underlying. So my long underlying is showing a proportionate profit, and my short call is showing a proportionate loss. So on a net basis, on a gross basis, I make a loss here, but on a net basis, I'm not making a loss. So above the strike price of the short call, I'm not concerned. Okay, so if you look at it again on a chart basis, so let's look at any chart, maybe. Right. So if I'm long Twitter, let's say, if I'm, let's say, a kind of an institutional investor, and a lot of these institutional investors are long only funds, so they have a tendency to be almost fully invested or heavily invested, because they need to show their investors that we're doing our job. So, and they're also afraid that the index might start rising, so they're all kind of quite heavily invested. So maybe they need to have some kind of a core position in Twitter. They have to be long Twitter to some extent. So this guy is thinking that, well, I'm long Twitter, but I don't think that in the next 1 month, I don't think that Twitter is going to go above 52. Okay? We'll ignore, we'll just use a round number. It's actually gone a little bit above, but we'll ignore that. So this guy is thinking that, okay, I don't think this is in the next 1 month. So he takes a view like this. I don't think in the next 1 month, Twitter is going to go above 52, right? So what he's going to do is he's going to start looking at 1 month options on Twitter, let's say. And we have some options here. Or you can even make this, I think it'll be easier to change this. Yeah. So let's say he thinks that 240, 1 month options above 235. So he thinks he's long Microsoft, but he thinks that there's no chance that Microsoft is going to cross 235 in 1 month. Okay. So he's long Microsoft anyway because he needs to be long some of the major stocks. That's his natural position. So now let's look at, he's talking about 235. So what he will do is, we look at options. Okay, we look at a straddle view. Let's look at straddle view. We just looked at, yeah, I don't think, yeah, it was 235. Okay, so let's look at 235 strike. 215 is the price now. Yeah, so 235, it's a very small amount. So we have to sell, if you see, if I sell the 235 call, the 235 call is worth only 4 cents. Not much value for money here, not much of a gain for me. So it's 215, so I have to look at something lower than that. So let's look at 220 maybe. Yeah, now this is half a cent, it's not that much. So, but even then, but this is because these are very short-term calls. So let's make a long, this is very, very short-term. So let's look at a January 15 call, roughly where we are, about a month away. Okay. January 15th, let's look at, so it's about 5 weeks. And let's look at the 215 call. 215 is here. Let's look at 220, and we can even look at 235. It's not too bad, huh? See, we looked at, we were looking at a very short-dated option. Now you see 235 call, I can pick up $1.52 per share if I sell a 235 call for 5 weeks, okay? So if you think about it now, in 5 weeks, now last time it reached around that level was 2nd of September. So since early September, Microsoft has been caught in this kind of a consolidation. So if I'm long stock, and if I sell a 235 call for 5 weeks, and if the market doesn't actually rise, if I'm right about my view that it won't go above 235, then I can sell that option, and I will pick up a neat amount of $1.52 per share. Okay, so depending on, let's say I'm long, if I'm long like 1,000 shares, if I'm long 1,000 shares of Microsoft, then I can sell easily, I can sell 10 contracts. I can sell 10 option contracts and pick up $1.52 into 100 into 10. Okay, this is $1.52 per share. One contract size options list for 100 shares. So total income will be $1.52, not including commissions, of course. So without excluding commission, because that will reduce your total income. So $1.52 into 100 into 10 contracts I'm selling. So I'll pick up that cash, and it can go straight into my pocket if my view is correct that the price doesn't go above 235. Now, what if my view is wrong? If my view is wrong and the price shoots up and finishes at 245 in 5 weeks, in that case, the 235 short call will be exercised against me, and I will be losing money. I will lose $10. If it finishes here, I will lose $10 on the short options, because 245 minus 235. But compared to today, which is 215, I would have already picked up because I'm long the underlying. I'm already long the underlying. So if it goes from here to 245, my underlying position is showing a profit of $30, right? Whereas here I'm losing $10. So I'm giving up $10 of my profit. I make $30, but instead of $30, I would have made $30, but instead of that, now I make $20. So I'm giving up some of my profit, so it's not a disaster situation. So that's why a lot of institutional investors do this as a strategy. They try to pick up income by selling calls when they're already, because their natural position, most of these mutual funds, you'll see their natural position is actually long stocks, stock mutual funds, because they have to be generally invested. So therefore their natural position is long stock. So they try to pick, they say that, well, I'm anyway long, can't help it, I have to have a long bias. So, and I'm a long, because I'm a long only fund. So let me just generate some extra income by selling the call. Okay, so this is a strategy that you should be aware of. So I deliberately spent a lot of time on this because I wanted you to make sure you understand, I wanted you to understand the sort of the institutional context in which this strategy is normally applied. Because otherwise I could have just told you that, okay, this thing is called covered call writing. That's it, like a mathematical formula. But I wanted to explain to you the institutional context in which this strategy is employed so that you understand the fuller picture. Okay, so it's called covered because you can see the short call is covered by the long underlying, which means you're losing money here, yeah, but you're making money here, so it's an offset. Okay, so this is covering. This is called a covered call writing strategy, very common strategy. Okay, so if somebody asks you in an interview, you can now explain what covered call writing is. But you should also explain, to show your knowledge of synthetics, you should also explain that this discussion actually comes up in the context, this discussion can also come up in the context of discussing synthetics. And we can also note that the covered call writing position, which is long underlying plus short call, is actually the synthetic equivalent of the short put. Okay, so you should mention that as well, so that you know so that you show your knowledge of synthetics. And even when you think about it, you should also think about it this way, so that you refresh your idea of synthetics. Okay, so which is why a lot of people say that covered call writing is a dumb strategy, because you're doing, because a lot of time people do it together, go long the stock and sell the call. So people say that it's a dumb strategy because you're paying more brokerage, buying one here, selling one here, and you're better off just go sell the put. Just sell the put. Do this side. Don't do this side. Just do this side. You have only one transaction. Just go sell the put. So I think you understand this a little better, why people do covered call writing using this. And the reason for that is this is done by people who are anyway long stock, because they're long only institutional investors in stocks. They're long only institutional investors in stocks. So therefore, they are already, this position is already there with them, so they're trying to pick up some extra income. That's the idea. Okay, so that's one. The second strategy that we wanted to discuss is also in connection with this. We'll discuss briefly is cash secured put writing. What does this mean? This is also used by some people. I mean, even Warren Buffett has used it, but he had obviously got some special concessions. We'll talk about it here. Buffett has used it, but with a condition that he will not. But obviously, everybody will not get this concession. Okay, or condition. We will not put up extra or any margin underlying asset price increases. Okay. What do we mean by that? Cash secured put writing, you can see now. So it's basically a put selling strategy. What you do is, if your view is, if say you want to go long Microsoft, you're ready to go long Microsoft, but you don't want to go long at 215. You think that there's a chance that it might come a little bit lower, but you might not get it all the way to 200. But if it comes to 200, you're happy to buy it anyway. Okay. So what you do is, you think that in the next 5 weeks, maybe there's an outside chance it will come to 200. And if it comes there, you're quite happy to buy it anyway. Maybe you have a strategy of selling it off if it goes below, if you stop it out at 195 or something like that. And you think that it won't go below this, but you think it might come to 200. So what you do is, then you look at, so you're saying right now you have no position in anything, underlying or options. And so what you're saying is that, well, if it comes to 200, I'm ready to buy the stock anyway. So why don't I make some money out of that view that I have? So let's look at the 200 put, okay? So your position is that your view is that you're ready to buy the stock. So you can exploit this view by selling a put, and if the price goes below 200, they would have sold you the stock at 200, the holder of the put option. So you would have been exercised on the short put, and you would get sold the stock at 200. You would be long the stock at 200. And you're saying, well, I don't mind that, okay? So in that case, you look at the 200 put for 5 weeks is how much here? See, 261. So the 200 put is 261, okay? And you can see this. So basically what you're doing is, you're selling a 260 at 261, you're selling a 200 put. Okay, so you can pick up this premium income. And if it doesn't come down to 200 and goes straight up, then fine, at some other point you will have to revise your entry strategy. Maybe you need to start thinking of buying it right away. But if it comes to 200, you'll get exercised on the put. But at least what has happened is, effectively you can say that your entry price is not 200. Your entry price is 200 reduced by, again including it, we are ignoring commissions. So it's actually your entry price is 200 minus 2.61, because you've already earned this premium, okay, by selling the 200 put. So what you do is, you sell this, you sell the put, but you make sure that you are, okay, course, all this ignoring commissions. Right? So, and cash secured because cash secured. Yeah, so it's cash secured because cash is earmarked and kept free. Okay, so if you think that you've sold the number of puts you've sold, if the puts are exercised, you will have to buy, say, $100,000 worth of stock. Then you make sure that $100,000 worth of cash is earmarked and kept free for the duration of the option, so that if the put is exercised, you have the cash to buy the underlying asset. Okay, so that's which will be sold to you. So that's why it's called a cash secured put writing. Okay, so this is also now the reason Buffett had insisted on this kind of condition, he obviously did it in massive amounts, because Buffett's view is also that there are certain types of stocks that he's willing to buy at a certain price. Okay, so he's trying to make money out of that. But his condition was, of course, that if you try to do this on Interactive Brokers, if you sell an option on Interactive Brokers, if you sell the put, let's say, if you sell here on Interactive, if you sell the put, the 200 put at 261, and then the market right now is 215, it starts dropping. Okay, the market starts dropping, and the put will keep on increasing in value as the underlying drops. So if it drops to 200, by that time the put would have increased in value by at least 15, because from 215 to 200, the intrinsic value of the put has gone up by $15. So the value of the put has also increased by $15. So you have lost $15. So IB is going to require you to pay up for the losses. Okay, your mark-to-market losses, you lost $15 per share and number of contracts into 100. So that's the amount of your loss, and IB will ask you to pay that money. And if you don't pay it, next morning, they'll sell off your position. So therefore, you have basically a margin call situation. Now, this is what Buffett doesn't want. He doesn't want to have to pay cash if the short options that he has created, if they start losing money, he doesn't want to put up margin. Okay, so he did this deal as a special deal, where he knows that he will not have to worry about because he sold a massive position in puts. So he wanted to be sure that he would not have to put up money if the puts started to gain in value. The puts that he had sold, if they started to gain in value, then he would not have to put up new margin calls. I mean, put up money for new margin calls. So he did not want that kind of a drain on his cash. So that's why he did it. Okay. So this is once again the background, institutional background. So, but Buffett was able to do it for you and me, because he's a big investor, and the other guy who bought the options from him, he did not have a problem with taking the credit risk of Buffett, so he agreed to the deal. But ordinary people cannot get this kind of a arrangement, so they will have to put up margin as the short put position increases in value, if it does. Okay, so that's one of the problems of this kind of a strategy. But you have, and partly you have the cash secured anyway if the put is exercised against you. So these are a couple of strategies: covered call writing and cash secured put writing, which we wanted to cover. Now we'll go back to the right. Okay, so we'll go back to our discussion of synthetics. Okay, we go back to our here. Now, the next underlying position that we're looking at is the long put. Okay, look at the long put position. We can cover this very quickly now, since we have done the idea of, I think once you do the first 2, 3, then you get very fluent in the rest of the positions. We're looking at long put. So the position is long put, this one. It's long because this segment is below the zero line. It's a long position, and it must be a put because it is making money as the underlying asset drops. As the underlying price drops, intrinsic value of the put keeps increasing, and you are long, so you are making long put. Okay, so this is the position, and the synthetic equivalent of this. How do you create it? And you go segment by segment. You got to create something where you pay some money. Okay, you have a part which is below the zero line. All right, so because you're paying up that money. Now you have to pay. That means this is basically a long position. That means there'll be some kind of long on the synthetic side. So since this is a long put, then the other one can't be a long put, so it must be a long call. So you got one part of it. You got a long call. Now long call will give you the part below the zero line, yes, but it will not give you this kind of profile. This part, we're looking for this part. Okay. Instead, it is actually giving you, the long call is giving you the other kind of profile. As the underlying goes up, as the underlying asset price increases, the long call position will keep on making money. So you're getting this profile, whereas what you want, I mean, in the part that's cutting the x-axis, you're getting this profile instead of getting this. So you need to cancel this out. You need something which will, you're making money as the underlying asset price goes up. Okay, so this is not worth it for you because you need something that will lose money as the underlying asset price goes up. So this can be cancelled out. So that will come from a short stock. If you go short stock, then this will cancel out this long call profile. So there will be nothing on this side. And also you see the short stock will give you what you're looking for here. It will give you this profile. Okay, so this is one. And this is therefore we say that the equivalent when you're looking at a short, you look at a long put. The synthetic equivalent of the long put is long call plus short underlying. You should not learn it here. The diagram is short stock. You should not learn it as short stock. You should learn it as short underlying. Then you can apply it in other asset classes as well. Okay. So that's one, and then we can quickly wrap up the others. Okay, short put we have, long put we are done. Short call. Short call will be, short means earning some money. Yeah, earning some money here, short, and losing money as the asset price underlying goes up. Okay, so that's your short call. Short call, you need to make some money, so it must be a short, so it must be a short put. So on the synthetic side, one has to be a short put. That will give you this part, money above zero line. Okay, premium income, short put. But you need this kind of profile, but what you're getting with short put is the other kind of profile. Money is being lost as the underlying drops. What you need is actually money to be lost as the underlying increases. So you need to cancel this out. You need something that would cancel this. You need something which will make money as the underlying drops. Okay, so therefore this will be short stock. What makes money as the underlying drops? And the other position has to be underlying position. when you're doing the synthetic, this is a short call. So the other two positions will either be put or stock. So therefore it is short put, you must earn this, and the other one must be underlying position. You need some underlying position to cancel out losing money as the underlying drops. That will be short stock. These two, and short stock will give you this profile, so you will have this. This will now cancel out this, making money as the underlying drops, making money as underlying drops, and cancels out this one. So these two cancel, and you're left with the income. And then you have this, the short stock will have position losing money as the underlying increases. Same thing. And then the last one, of course, is long call. You can see long call. This is the long call. Okay. You need to have long something. So the other one, when you're doing the synthetic, it will be something other than call. So it will be long put. Here you can see. But you need this. Long put is giving you this. You need to cancel this out in the underlying position through an underlying position. And what is that cancellation? You need some kind of underlying position which will offset this. What is this? This is making money as the underlying drops. No. You need something that is going to lose money. You need an underlying position that is going to lose money as the underlying drops. What is that? Must be short stock, must be the long stock. Because if you're long stock and the underlying drops, you're losing money. So put on long stock, second component of the synthetic portfolio. Then this long stock will cancel out this part, cancels out this part, left with this. And long stock also has the feature of making money as underlying rises. Okay, so this part comes out from here, making money as the underlying rises. So here we have covered all the 6 positions, 2 positions in underlyings, 4 positions in options. All the synthetic equivalents we have covered. We covered some fundamentals. Okay, so your time is up now. So I will dismiss the class, and remember that tomorrow that class has now become. You got the mail from Manik sir?
Yes, sir.
Yeah. Okay. So we will not meet tomorrow. We'll have on the Saturday. We'll have the last 2 classes. So okay. So that's dismissed now, and anybody who has a question can stay. The rest of the class can leave. Yeah. Anybody has a conceptual question? Any kind of theoretical doubt? Okay, good. So we can end it here, and I'll see you guys on Saturday. All right.
Thank you, sir.
Okay.
Thank you, sir.
Is Mithali here? Mithali, I just wanted to check about your account. Is she here? Okay. I guess then her account must be okay because she had some administrative problems in her account. I guess she must be okay. Okay, we'll stop it here. We'll see you guys on Saturday.